Hi, I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. Charts That Matter is going to be a series we've created to help folks like you visualize data we use to help secure your financial future and make things easier to understand. We'll be highlighting information we find particularly interesting as we make our way through the fiscal year end. Today, I'm going to talk about interest rates and the yield curve. The first picture shows us our Treasury yield curve. And to begin, I want to start with a definition of a term that we use called the term premium. The term premium is defined as the compensation that investors require for bearing the risk that interest rates may change over the life of the bond. At the bottom of this pic, we show a normalized yield curve. And what that means is that if you're going to lend money for someone for 10 years, versus 2 years, you should expect additional compensation for locking your money up for the longer period of time. We call this an upsloping yield curve. What's interesting in today's environment is that the yield curve is inverted, which is the top line. An inverted yield curve basically means that long-term interest rates are less than short-term interest rates, and it's considered very unusual because it reflects bond investors' expectations for a decline in longer-term interest rates. The other notable thing with inverted yield curves is they are typically associated with recessions. The second picture shows kind of an interesting environment that we find ourselves in. What we're measuring here is the inversion from the 3-month Treasury bill to the 10-year Treasury and the length of inversion. It's actually been the longest period of inversion dating back to the 1980s, which is why we've consistently seen market pundits calling for a recession. However, our institutional strategist, Tavis McCourt, made an interesting observation that we can see on the next chart, that it's not necessarily the inverted yield curve that matters, it's its renormalization into an upward sloping curve. And how does it become upward sloping? Well, traditionally it can be one of two ways. Historically, it's short-term rates declining. That generally happens when the economy weakens and the Fed cuts interest rates. This was sort of the market expectation in the second half of 2022 and into the early part of 2023. Now, not that that's out of the picture, but what we're seeing is perhaps another way we could have a normalized yield curve, and that could be the economy proving it's more resilient, the bond market rethinking the previous assumption, and longer term yields actually rise while shorter term yields maybe stay where they're at. So if we look at past normalizations of the yield curve, traditionally, as I said, it's short term rates fall. We saw this in 1989 when the yield curve was inverted. However, we saw that the recession and job losses didn't start until the spread was positive again. The same thing in the early 2000s. As well as 2006. Time will tell what happens in this current environment. But that also brings us to our investment implications. Many of you are very comfortable at this time being comfortable holding cash because of the high interest rate that you are paid. But as we think about investment implications into the future, if short-term rates do fall, the yield on your cash is going to drop versus investing in some longer dated bonds. So what these two charts are showing is bond returns following the past peak in yield curve inversions, as well as returns after the Fed has stopped hiking interest rates, which both go hand in hand. And you can see that the return we can expect from core bonds, which is investing longer out in maturity, can be significantly higher than money markets. And the reason for that is when interest rates fall, bond prices rise. If you have any questions or concerns about how this affects your portfolio, please contact us. If you found this information interesting and useful, stay tuned because Accrue Wealth has more to share. Thank you for your trust in us.